time as well.
Good advice. Catherine from Sydney, you're on the line. Welcome to the show.
Hello. I have my question.
Go for it.
Okay, I've just rented out my property, which, I bought as a first-home buyer, and I've just decided to move out and rent it out. And my question is, I've got some money in the offset account, and I'm thinking, because it's now a rental property, shall I take my money out and, put it in a savings account somewhere so that it's not offsetting my interest on my loan?
Well, that's a good question, actually. I mean, you've got, I suppose, two things to think about there. Now your interest is tax deductible, so the actual cost of your interest is a lot lower now. So I think the key, though, is what you're going to do with that money if you do take it out of your offset account. So, whether you're going to invest that in a product or whether that's shares or in another property or what it is, to create more wealth. I think that's the key. I mean, that's the whole key with negative gearing. People have to understand with negative gearing that, in actual fact, you're making a loss in real terms when you're actually negative gearing a property. Most of the time, the value comes in the appreciation of the property at the end of the day. So although the tax office helps you and your tenant helps you pay your rental property off, you actually still need to finance that from a cash flow perspective, and you're hoping for that big pot of gold at the end to make the whole investment worthwhile. So, I mean, I'll throw this out to these ladies as well, but I would have thought one important thing would be, what are you going to do with that other money? I think sticking it just in a savings account probably isn't enough. I think you need to do a bit more than that.
Yeah, I'd agree, and it is about the relative on the tax, because if we took, for example, that money that you take out of your offset means you've now got a higher loan, if that's going to then incur, say, a 9% interest and you're on a 30% tax bracket, it means the tax is going to cover 3% of that interest. So you've now increased your interest costs by 6%. So you would want to make sure that whatever you do with that money, you're now going to invest that, so that's earning 6% plus whatever you're going to pay on tax. So you want to end up with at least 6% after you pay tax on the earnings, just to break even. Then you'd want a little bit higher because you're obviously taking more risk. Putting the money in the offset account is fairly low risk because it's still with the bank. So you need more to offset the risk. So you're starting to look at more growth assets, which I agree is looking at shares, property type investments. And then to do that, you do need a longer term. So again, you would have to be prepared to be invested for a 5-year plus period to make that worthwhile. So it's about where your objectives lie and can you afford to do that.
We've got time for